The friendships we have with people who loan us money. Yes. Bonds are just when companies borrow money effectively. All right? When you and me go in place and we borrow money, we go, hey, bank, I got this house, or hey, look, I'm just awesome and I make money, so loan me money. It's just a loan. But when a company says, hey, we need some money, here's our terms. It's called a bond. All right? Now, normally, when you and me think of borrowing money, we usually think of going to a bank or a buddy and, doing it. Or you might be used to DeFi, but let's pretend DeFi barely exists for this example because DeFi is so much better than the normal process. It kind of makes it irrelevant. So just play with me. This is a historical thing on bonds, if you will. All right? So, a bond is just when a company goes and says, hey, we're going to issue some debt, all right? We need a par value, usually $1,000 per unit, all right? We're going to pay this much in interest, okay? And they usually go to an investment bank and say, hey, or at least the big companies do. They say, hey, will you find people to buy these bonds we're going to issue? Maybe we'll, borrow $100 million at 5%. Here's our terms. We'll do it over 10 years. We'll pay back at this particular time. And you think you can find somebody to do it? And they'll be like, of course, for the right fee, we can find anything. And, then they pay an egregious fee to that. But that's fine too. So, these bonds, they'll send them out to pension funds, to banks, dumb banks usually, to wealthy individuals, and they'll blow up your phone and be very annoying, like, hey, we've got this great 5% bond, and you can tell them, great, I don't want it. I'm making 10 times that in DeFi, and they still keep calling. No one in particular, but a few people really need to lose my phone number. Anyway, enough about my own complaints. So, these bonds, they pay a regular coupon. Some of them pay it monthly. A lot of them pay it semi-annually, though, which is twice a year, in other words, every 6 months. And what they do is they just have a stated interest amount, and they go, okay, let's say I'm paying you every 6 months, and I'm paying you 5%. That means every 6 months you're going to get a coupon, they call it. It's basically just a check for 2.5% of the face value of the bond. Okay? The face value is also known as the par value, by the way. Now, the par value per unit is usually $1,000, but of course there's always exceptions, like with everything else in the world. Now, what happens over the life of this bond? You just keep getting your coupon payments. There's actually bonds that get issued, and they're called zero coupon bonds, and they're issued at a discount. These are less common, and a lot of times they're done by governments, but they do happen. I am not a fan of these kinds of bonds very much myself, but they do exist. Now, at the end of the bond, on the maturity date, that's when the bond is meant to be repaid, the full principal of it is given back, you will get back the initial par value of the bond, which is usually $1,000 per bond unit. All right? But there's actually a cute little thing that can happen. See, sometimes people get worried that a company might not repay. I mean, that happens quite a bit, actually. So, what happens if people are afraid the company won't actually repay their debts? Well, it's simple. Those debts start trading for less than the face value, less than the par value. Sometimes drastically so. There was actually an event that I got to take advantage of a little while back. There's a little country called El Salvador. You may have heard of them. They've got a very interesting leader. I personally like him. He's really trying to fix up the country. Yeah, he's had some rough times, but honestly, he's trying hard, and I can really admire that. Their national currency is Bitcoin. They're getting on the right track. But they had a massive amount of debt outstanding, or at least for the size of their country anyway. And their bonds were trading for like 45 and 50 cents on the dollar, which means I could buy a bond that had a stated par value of $1,000 and I could buy it for like $500. So if these bonds were paid back in full, when they did this, I would take my 50 cents on the dollar and turn it into 100 cents on the dollar. 100% return, plus the entire time I'd be getting a coupon payment. Now, the coupon payment is really interesting because when they're trading at a discount, they're still paying the full amount. So I forget what the exact coupon on these particular bonds were, but when I got them, they were trading for like a almost 20%. It was just crazy. And the reason the coupon was so high is because I was buying them for a fraction of the face value. And so when you're buying a bond for half the stated face value, the coupon is effectively doubled, which is just crazy. Now, obviously, this is third world country debt. It's a little bit riskier than, it's a lot riskier than most other debt. This particular time, I actually felt pretty comfortable with it, and they did end up paying their bonds, and it's turned out quite well for me. But do your own due diligence before you buy third world country bonds. Trust me, it's very easy to lose mountains of money, and repossessing stuff from a country is a lot harder than you'd think. But if you do your homework, you can actually find some interesting opportunities in the bond market. Now, we talked about what happens when a bond is trading for less than the par value, because maybe people are a little concerned. What happens if it's trading for more than the par value? Now this I don't like. This is one of those things that I feel is relegated to very dumb pension funds and other people who waste other people's money. Because why would you ever pay too much for something? I mean, honestly, there are reasons this happens. There are valid reasons, like say interest rates drastically changed and so the value of the bond has went up. You see, a lot of times bonds are issued relative to the current market's interest rate. So if interest rates are going up, the value of the bond might go down to compensate so that the interest rate is equal to the current bonds. But the face value of the bond had to fall so that if you buy it now, the interest rate would go up to that. Well, the opposite of that can happen too. And when this happens, when interest rates have fallen, you might pay an extreme premium for a bond. If interest rates cut to half of what they're currently at, the bond may trade for double what it's otherwise worth. That way the interest rate is competitive with current interest rates. There's just one little teeny tiny problem. If you buy a bond that's trading at a premium, especially an enormous premium like double or something, when it comes to maturity, you're getting the face value back, not what you paid. So if you paid, $2,000 for that bond that's worth $1,000, you're getting $1,000 back. Congrats, you just played yourself. Now, there are ways to take care of this. There's ways you can kind of hedge it and stuff. But why pay double when you could just go buy something else at its face value that's good? It's the same thing. You just aren't paying a premium for no good reason. Now, I don't have a great answer for that. There are ways to hedge it. There are things you can do. Or you could just buy the other bond. But pension funds love to waste retirees' money. So they love doing this. And it's something that just bothers me to no end. Because, these people aren't looking out for the average person. They really should be, and they're just not. But there's no fixing it. Fidelity, Schwab, all them, they're just going to keep blowing these poor, hardworking people's money. That's one of the reasons we had to make the Overlord Club, actually, so that you could take charge of yourself and get a good return and not get 4% in a market that averages 9 to 10%. But anyway, I'll stop whinging about them just terrible retirement investors, and let's wrap it up, shall we? Now you know about bonds, but do you know about all the convertible features of bonds, the special bespoke rights that might be attached to them? You see, some bonds you can actually convert into other things, such as equity in the thing that issued it. Now, this is a special add-on, and usually when you have these special add-ons, like a convertible bond, it reduces the actual interest rate of the bond that's offered, because it's a perk. It comes with a perk. You're not getting a perk for free, usually. I mean, if you are, congrats, great deal. But usually when you get these bonuses, you got to pay for them. And you're paying in this way by getting a lower interest rate. Now, there are also other features that can be tacked on. You can have special liquidation things. You can have the bond collateralized by specific things. But, again, whenever you have these special features, you usually have to pay for it, meaning lower interest rate. Now, there's also an option for the seller of the bond to call it due. Sometimes the buyer of the bond even has a right to call it due. When the seller of the bond has the option to call it back early, usually this is seen as a perk for the seller of the bond and something that you have to endure as the buyer of the bond, which means you might get a higher interest rate, which is always lovely. I love higher interest rates. I'm perfectly happy if you're willing to call the bond back. Now, people that buy bonds at a premium, they don't like that feature because you know what? Their stupid decision gets punished. When someone buys back the bond you bought at $2,000 for $1,000, way to go, way to go. You really made a wise choice on that one. But if you bought it at a good value, or even better, if you bought it at a deep discount and they call it, oh, thanks, you paid me early. That's how we like to roll. Or at least that's what I like to do. I don't know. If you disagree, have fun losing money or making a lot less, either way. But when the buyer has the option to call the bond due early, usually this is seen as an extremely valuable feature for the person who is buying the bond. And so they're going to take a lower interest rate on it. And usually they can't just call it at any given time. Usually there is a specific time period, maybe after 2 years after issuance, or every 2 years for this 30-day period, or something like that. There's different terms that apply at different times. But at some point, you will have the ability to say, hey, here's the bond. I want my money now. Yeah, pay me now. And if it's during the right period of time, they will have to do that. Usually they'll do this by issuing new bonds. And so they usually have expectations that interest rates will do a certain thing or that a certain thing will happen in their business and they can get better terms in the future. And that's usually why they'll offer that. So it'll be like, cool, we're expecting to have a better way to do our bonds anyway. So we're going to offer this to you, get a lower interest rate, a little bit of a win-win for them. Not always. Sometimes it's just straight up to lower the interest rate. But a lot of times you'll actually see a little strategic thinking on that, which is nice. I like my companies to do smart things. Now, sometimes you can also have a convertible option so that you can turn your debt directly into equity in the company. Sometimes even into preferred equity in the company, which still ends up looking kind of like a bond, but a perpetual bond, which it's a feature that I really like. It's a very, very uncommon feature for it to turn into a preferred stock, but you do sometimes see it, especially in weird European markets sometimes or third world countries. It's a nice little thing if you can find it. But again, do your due diligence and remember, bonds change drastically in value based on a few key metrics. The borrower's ability to repay, the interest rate environment that you're seeing it in, and a third thing that we didn't talk about very much so far, the currency risk. You see, you can assume that all bonds are denominated in dollars, and most bonds are denominated in dollars. The dollar market is huge. It's just absolutely enormous. The American economy is fantastic, but there are bonds denominated in euros. There are bonds denominated in Japanese yen, Swiss francs, and even a few out there in Chinese yuan, though I'm certainly not touching those. And the valuation difference between different currencies, maybe you have it issued in one thing and it settles in another, these risks can cause changes in the underlying bond value. Now, it's going to be very rare, especially as an American investor, for you to find a bond where it is generating its revenue in, say, Japanese yen, and you're getting your payout in US dollars. But you can find some like this. In fact, Sony and stuff, with their financial industry heavily tied into their actual other business sectors, you'll see a lot more of this from places like Japan, which is really interesting because until recently, the Japanese yen has held up significantly better than the dollar in a lot of ways. And so some people have been able to play that off where it's like, okay, maybe I'm earning 0.5% less interest, but I'm getting it in Japanese yen buying power denominated in US dollars in my account, and you end up actually having a superior return. Now, these trades can get really complex the more you layer onto it. So we'll save all that stuff for a different time, but just something else that you can look at and play around with. I'll catch you guys next time. See you then.